All right.
Yes, sir.
Okay. Okay. And we are live. All
Fantastic.
right. Here we are. Good evening. Good evening. Welcome everyone. I'm Anthony Bowling with the Anthony Bowling Group. I am again here. It's Wednesday, 5 p.m. and welcome to another episode of Chasing Gazillions. Ain't the same as making millions. I'm your host, Anthony Bowling, associate broker and director here at KW Commercial. I'm your local career real estate coach in a box. And every week, every Wednesday at 5 p.m., we go live talking about opportunities to advance your career as a real estate professional. What does it really take to be a successful real estate professional? What's the pitfalls, the myths, the realities? We talk about it here. I'm here as your career real estate coach on Wednesdays at 5 to answer questions for you based on my 30 plus years of experience as a licensed real estate professional here in the DMV area. Today, however, we have a special presentation. We have invited a special real estate professional to come on board and talk to us about a subject that's near and dear to your heart and to everyone's. We're going to be talking about grandma. So it is 5:05, and you all know I like to get started on time. So with no further ado, I want to introduce to you Mr. Dennis BoBo of PBF Global LLC. Dennis, are you there?
I'm right here, Anthony. Yes, I am.
Fantastic.
Great to be here.
Well, Dennis, welcome to the program. Can you see your screen?
See clearly. I see Grandma right there. I see Grandma's house. Everything is very clear.
Fantastic. Well, Dennis, again, I want to welcome you to Chasing Gazillions is not the same as making millions. We're so excited to have you on the program this evening. We are so looking forward to learning about tax and financial planning solutions for grandma. I've been excited to bring on Dennis. You are my first guest.
Oh, wow.
On Chasing Gazillions.
Oh, wow.
It's not the same as making millions.
I'm privileged to be in your presence in general. I'm ecstatic to have that special place. So
that special place. Mark this day. This was the day
absolutely
that we had our first guest come on board. So with that, I'm not going to take up any more of your time. Please introduce yourself to our audience. Dennis, you need to know that not only on this Zoom call, we have guests, but this is being streamed live on Facebook, Twitter, Instagram, YouTube, and I think Pinterest. Maybe Pinterest, but maybe not. But it's going live. So you are live with our audience. Dennis, take it away.
Well, my name is Dennis BoBo, and I'm honored to be here on obviously this expansive platform. I am merely a humble tax servant, and where I through my service as a humble tax servant, I've had the opportunity to learn a few things, experience a few things, and become wiser about a few things, from tax preparation to tax resolution to tax strategy, and ultimately what I really think is most important, tax planning. And I I think the example of grandma is something I think when we're talking about planning and strategy, but it speaks to all of us, to our Nimas, to our mothers, to our grandmothers. I think my mom is on right now, so I'm talking to my mother right now. So I think we can all relate. Anthony, if you want to get started with the next slide, we can hop right into it. All right. So here's a scenario, and I'm going to talk to you. I'm not going to talk. I'm not going to. I'm not going to talk. IRS code section. I'm not. We're not going to have that kind of conversation. I'm going to have a kind of conversation I would have to my grandma if she was with us, to my mom, to my mother-in-law, to the grandma, to the auntie in the church. That's the conversation we're going to have today, because I'm going to make it simple for you, so you can make it simple for that special lady, that special wise woman in your life. So we find ourselves in this scenario, in a very common situation. I mean, as you may have noticed in the District of Columbia or wherever you reside, the price of real estate seems to continue to appreciate. It stabilizes. So grandma is she's ready to retire. Grandma has stopped working. Grandma is currently receiving Social Security. Grandma bought her house many years ago, her home probably about 30 years ago, and she's got an investment property that she's had for pretty much an equal amount of time. Grandma's ready to move to Boca Raton because that's her girlfriends are down there. She wants to have some fun in the sun in her well-earned years. But one of the things about it, well, grandma's situation is a little bit interesting. She's fortunate that the home she lives in, which she got for about $200,000 back in 1990, well, it's appreciated to about $400,000, and that's fine. She's not going to have any tax problems with that. She shouldn't, because that's excluded. But grandma was also so fortunate to pick up about 30 years ago a rental property, investment properties that she got for a really great price. Matter of fact, when she got it, let's just say we're in Washington D.C. and it was on Capitol Hill, and it was pretty rough at that time. And she got it. I don't know. Maybe she got it on a wholesale price of $50,000, what have you. But ultimately, that investment property is now going to be worth $1.25 million. So she didn't really have a problem on a $400,000 home that she's living in, that she's selling, but grandma's about to get $1.25 million. Grandma's going to be able to hopefully retire into the sun, and really enjoy the remainder of her retirement years. Now, she's going to go to Boca Raton. She's going to not have to worry about Social Security, but grandma's got some problems that we're going to see in the next slide that I think you're going to want to take a look at. And here's grandma's problem. So, well, first, before we get to the problem, grandma's about to walk away with about $200,000, no capital gains. She's going to have $400,000 she's going to drop on her condo in Boca Raton. Grandma's good. She's not going to pay any taxes on it. She's going to have fun in the sun. But grandma needs some money to live with. But grandma has one problem. And it's not the place that she lives. It's not the house that grandma lives in. The problem grandma's going to have is on that investment property, that $1.25 million. That sounds like a wonderful number. And Anthony, if we can go to the next slide, we're gonna talk about what problems we got to solve for grandma. So grandma's first problem is this. Grandma's going to probably have $250,000 to $300,000 tax liability on that $1.25 million. Now, grandma wasn't looking for this tax liability. Grandma said, look, I'm tired of fixing the pipes I'm tired of getting those calls at night saying, look, the electricity's not working, or the calls, could you please come have somebody come shovel the snow? Grandma doesn't want any parts of that. She left her government job about 10, 15 years ago. She's ready to sit back and and hang out in Barnes and Noble or Friday happy hours and pina coladas on the beach in Boca Raton. Grandma does not want to have it. She's done her job. Kids raised, grandchildren. You know, that's the only effort she wants to put in for grandkids. So, but unfortunately, on that $1.25 million, she's going to have about a $300,000 tax liability at the very least. So that's something we got to solve for. And here's the thing: it's great that $400,000 from the house she lives in doesn't have any tax, but after she buys her condo, she's gonna need some lifetime income, and it looks like the government's gonna take about $300,000 out of that 1.25. Grandma got to live, you know. Next slide. Fantastic. So we stated the first problem. We stated that there's going to be the sale of real estate. We stated that there's no liability issue as it pertains to a personal residence, but the sale of the investor property is going to trigger a long-term capital gain. Now that's not terrible. Capital gains. Let me tell you one thing about capital gains. If you want to get taxed in any way, form, or fashion, you'd rather be taxed at a capital gains rate than you would be taxed at an ordinary income tax rate. Capital gains tax rates are much more favorable. 15% is far better than 35%. Now, grandma had made $1.25 million in W-2 wages. She paid 35% on that just on the federal side, let alone what she will pay state and locally. So 15%, technically, in the big scheme of things, no, it's not bad. But it depends on 15% of what. If it's 15% of a dollar, okay, I mean, I'll give up 15 cents. I'm cool with that. But you get 15% of $1 million, $2 million. Well, that's a different story. You know, that's the difference between like, well, am I going to go for the dollar menu at McDonald's, or can we at least, have a meal at, I don't know, Red Lobster? Or maybe even can we go to Ruth Chris? Every now and then. That's what 15% is. And so this is the kind of decision grandma has to make when she goes to Boca. Is she going to go to Boca? She can go to Boca. She can get the condo. Is she going to have to go to Boca Raton and eat tuna and sardines, on the beach, or can she go to the restaurant? And let's go to the next slide and see what grandma's maybe a solution is for grandma. All right. So here's what's going to happen. Grandma's going to sell, as I said, we're going to sell that $400,000 house. She's going to buy that condo. Out of that 1.25 million, grandma's going to keep about $175,000 in pocket change. All right. She's like, government be damned. I'm at least taking $175,000 and put it in my pocket. I'm going to at least be able to buy some furniture for the condo when I get there. I don't know what the first year is going to look like, but I'm at least going to Ruth Chris one time while I'm in Boca Raton. And grandma always saved for a rainy day. So grandma's going to take some of that money and she's going to make sure that if something happens, that everything is okay, because grandma always saved 10 cents of every dollar. So that's just how grandma is. Grandma's old school. But all but $175,000, that still leaves us with close to $1 million that's going to be subject the capital gain. So in that example, we talked about 15% of a dollar is 15 cents. 15% of $1 million. Well, we're talking about, that's just federally, like $150 plus $1,000. You know, we're not talking about state and local. You add that up, now we're $250,000 plus at the very minimum. So this is what grandma has to deal with. And then here's some other things with that. I'm not going to get too technical. I'm not going to talk about adding back depreciation, which increases the price of what's going to be taxed. We're not going to get into all of that. That's a whole nother conversation. We can, if Anthony so kindly brings this humble servant back, we can talk about add back depreciation and capital gains, but that's another conversation. But to get around that, you know, I don't want grandma to feel the pain of that 15%. So we are going to set up a charitable remainder trust for grandma. All right. And I'm going to protect grandma from 15%. And what's going to happen when I protect her for 15%, you know what's going to happen? It disappears. So what we're going to do is we're going to take those proceeds and we're going to put them in this charitable remainder trust, and there's going to be zero capital gains. How do we get to zero? Well, what is a charitable remainder trust? A charitable remainder trust is an irrevocable trust where there's a remainder beneficiary that happens to be a charity, and that there's an annuity in that trust that takes care of the immediate beneficiary, and that immediate beneficiary is grandma. And when you put the money in there, it becomes free of capital gains, just as if you were making a donation to your church. But the first donation grandma is going to make is to herself in the annuity and the trust. Now, when she does that, grandma's going to get $150,000 along with that, along with not paying any capital gains. Here's a kicker: zero capital gains, but she's going to get $150,000 itemized deduction. I don't think you really understand what I'm saying to you. She's going to pay zero capital gains. That's number one. So on $1 million, you said 15% of a dollar is 15 cents. 15% of $1 million, at the very least, federally is $150,000. She's going to pay zero, federal and state. And she's going to get, I get excited, so forgive me. I'm sorry. I get excited about taxes.
That's all right.
I'm a tax servant. Forgive me. I'm a calm. I got to slow myself down because taxes just, I don't know. It's my caffeine. That's my espresso. I don't need to go to Starbucks. Let's just talk about taxes, and I get excited. That $150,000, she's going to get, on top of that, $150,000 itemized deduction. That's in addition to. Now, based on what grandma's tax rate, say grandma's balling, you know? Well, she gets 60% of her adjusted gross income as a write-off. I'm getting too technical. Sorry, grandma, my bad. All right, but she quite possibly will be able to write all that off in years of the transaction. Now, that's important because grandma kept $175,000. Now, that would be subject to income tax. But because she's got $150,000 itemized deduction, it's going to be pretty close to zero income tax on that too. In the end of the day, when we look at income taxes on the savings on $175,000, and we look at the tax savings on the capital gains, grandma saved over $250,000 with the charitable remainder trust. Now, I think grandma was going to be able to be okay, but after let's go to the next slide and let's see how things are going to work out. So we talked about the fact that grandma's going to gift almost $1 million to the charitable remainder trust. We talked about the fact that grandma's going to have basically almost $0 income tax and capital gains tax as a result of that. But one thing one of the problems, one of the things that's of greatest concern, we want our latter years to be better than our former years. All right. So in this scenario, grandma's going to be just fine, because what's going to happen is grandma is now going to receive, because there's annuity in the trust, and it says remainder trust, and we said that the remainder beneficiary is the charity, but the first and initial beneficiary is grandma. And so that $1 million that she put in there and got a tax deduction for, and that she's got zero capital gains on, she's going to be the first recipient of that in annuitized payments, which is going to provide her quality of life income for the remainder of her life. And Anthony, if you go to the next slide. So in that lifetime income solution, grandma's gonna be okay. Grandma, first, like I said, she's old school. She has that 175 in year one. She's gonna be comfortable. She put $400,000 from the sale of her real estate down on her condo on the beach. She's comfortable. She's not going to have a mortgage on that condo on the beach. She can look out her window and not have stress of her tenants calling her, telling her that the pipes are busted and the electricity is not working. And she's okay. And she's in grandma, she's getting Social Security already. So she knows she's got consistent cash flow coming in. All of her needs are taken care of. She's got health care and Medicare and all of those things. And she has savings already. This is not all the savings that grandma has. Grandma's got some mutual funds and some other savings and what have you. So she's done the right thing. She's got as Dave Ramsey might tell you to do, at least have 3 to 6 months of emergency reserve. Grandma's like that. Grandma's old school. So year one, her income that she's actually going to live on is that $175,000 net tax free, almost $175,000 from the real estate transaction that she's living on immediately, and her Social Security. So grandma's going to make almost $250,000 of liquidity in year one. Now year two, because that's great. That's year one. We can have right now money, but we want to have tomorrow money. We want to have generational money, what have you. Grandma, from that annuity, grandma that's in the remainder trust, and grandma's the initial beneficiary, grandma's going to receive about $45,000 to $60,000 a year in annual income in perpetuity of her life. And along with that, she's still going to get that $20,000 plus of Social Security. So just on that alone, if grandma didn't have, if grandma didn't get a retirement from her job. Matter of fact, what we're saying is this: grandma's retirement was that investment property. That's what we're saying. We're saying all grandma's got from the job that she has is Social Security. They didn't give her a pension, and grandma had to work hard for the pension she got, and that's that investment property. That's why that 15% is so important. Grandma didn't work at IBM for 40 years. She didn't work for the Department of Justice for 30 years and come in the ground floor and have lifetime income equal to her salary. But grandma, she worked hard for every penny and she got and she saved. And that's why it's so important. And grandma is now able to retire with dignity. Grandma is able to leave enough where she can, with planning and strategy, we can structure it where she can even leave an inheritance to those who follow behind her. Anthony, next slide. So what did we accomplish here today? One, we minimize capital gains. We understand what capital gains are. We understand that long-term capital gains are 15%. We understand that 15, it could be 150,000 on a million or 15 cents on a dollar. We did some retirement planning today. We talked about a real estate transaction, but that real estate transaction dealt with more than just the taxes on the real estate. That real estate transaction facilitated her retirement for the rest of her life. We created a tax shelter. We created a tax shelter on the initial transaction with the remainder trust. We created a tax shelter on current immediate income with the itemized deduction. And if grandma has, and I'm gonna get a little technical here, if grandma has a lower adjusted gross income, she's gonna carry over some of that $150,000 itemized deduction into the next year to shelter some of the money that's coming from the annuity that she's gonna be receiving from the proceeds of the real estate in the future year. Now, of course, now I've got here that we could solve for some other things, and that's not in this presentation. Under normal circumstances, I'd advise that we have an indexed universal life outside of the charitable remainder trust that allows to have long-term care and leave an equal benefit for her beneficiaries, but that's not this conversation. But she could do that too. Also, another benefit that's not here, what did we accomplish? We said there's a remainder beneficiary. Well, that remainder beneficiary could be First Baptist Glen Arden. It could be Grandma's Charitable Family Foundation. It could be her alma mater, H.D. Woodson Senior High School or Morehouse College. Well, not her, but her son's alma mater. And sure, and she's left a legacy as well. So grandma's accomplished a lot with this, and she's done something that's not only going to benefit her and of course her grandkids, but also future generations. And more importantly, she's going to leave an example for others to follow. And Anthony, last slide. If you're interested in having a conversation, if there's a grandma in your life that you want to help bring guidance to and facilitate walking through and navigating her transaction for herself and for those who follow, I'd be glad to help facilitate you in that process. And just you can contact Anthony, and I'd be glad to work with him in any transactions you have, or you can also contact me at 301-658-2310, or just go to www.globaltaxsolve.com, click book an appointment, schedule something, and I'd be glad to have a conversation to share what little information I've humbly gathered over the last 20 to 30 years. I'm still learning. I'm not a master. I'm always a student, always to be corrected, always to be improved. But my heart is in tax, being a facilitator to your situations.
Well, Dennis, I just want to thank you humbly. I greatly appreciate the information you have shared with our audience today. There was a gaggle of people on the line, Dennis, and there was there was questions here, and so we're going to break and go right into the Q&A section of the presentation here right now. And let's see, there was Okay. Let me see if I can stop sharing. We got a lot of people online here in the box. And so please, at this point, hi, I'm Anthony Bowling. Yeah, put your questions into the chat. We're going to be, we have time here for Q&A with Dennis BoBo to answer all your questions you may have. Yes, you're all still on mute. And so let me read out the first question we got here. Dennis, tell us, what causes the sizable tax burden?
Sure. In this particular transaction, and also in a lot of real estate transactions, the sizable burden is going to be the capital gains. That burden may increase for a number of things. I guess we get a little time here. We can talk about add back depreciation. You got an investment property. You might not have ever written off or depreciated the property, but the IRS says, well, it doesn't matter if you did or you didn't. They're actually going to add on what you should have depreciated to your sale price. So that's going to increase your capital gains. And think about this. And then, well, just time. As assets increase in value, if you buy something for $1 and it's worth now $100,000, well, that $99 you're going to get taxed on, And then if the IRS is adding back depreciation and it's not really $99, but you're taxed on $150 because of add back depreciation, well, that's going to add to it as well. And and then if in fact, on top of it, depending on how it's structured, you may have income tax on top of capital gains tax, depending on how the transaction is structured. That's going to add to it as well. So those are the things that cause the inflation of taxation in this particular example.
Okay, great answer. Okay, we have some more questions pouring in. Let me see. CAM, would it be better to buy real estate under a trust? Buy real estate under a trust?
That's interesting. Well, that's very, 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 very interesting. Let's see. There are probably multiple scenarios where that can work. I always advise folks when they have real estate that's paid for in full, particularly if it's going to be investment property or personal residence that's paid for in full and they're getting older in years, is to put that asset into trust. Now, getting outside of the tax situation we're talking about here, more for an asset protection person, particularly say in the event of someone like grandma. Grandma was holding on to her personal residence that she was selling, or even the one that she purchased. I would probably advise that since she's buying that fully in cash, I would advise grandma to purchase that property and place that into an irrevocable trust. And that's another part of the conversation that we've not had. We can have that conversation, but the reason I would advise that is for this reason. If something should happen to grandma where she would have to go to a assisted living facility or something of that particular nature, grandma's assets would be looked at, and what would happen, if it was costing a lot of money before they went to Medicare or something of that nature, or even her long-term care, they would go to her assets, her tangible and liquid assets first, and they would use that, extract from that to cover grandma's costs. So grandma, no one wants to be in an assisted living facility. We don't plan for that. We hope it doesn't happen. Hopefully let me say this. Yes, hopefully we have planned for the unimaginable. But if in fact that real estate was in a trust, then it would be protected, quite possibly from what's called a 5-year look back. And what happens in this particular situation? The nursing home or assisted living would say, okay, let's take it like this. If grandma put that home in a trust and they looked at grandma's personal net worth statement, they would say, okay, with a $400,000 home, it doesn't show up. Matter of fact, that $400,000 home is invisible because technically grandma doesn't own it. The trust owns it. So you know what? Yeah, though grandma lives there, grandma has full control over it, but it's owned by grandma's irrevocable trust. So it can't be liquidated. That's $400,000 out the window. And here's another thing: that million plus, probably million plus dollars that's now in the annuity and the charitable remainder trust, can't touch that either. Because again, that's in a trust and be liquidated. Doesn't show up on their statement of net worth.
Okay.
Technically, grandma, all she's got is Social Security, even though she has control of almost $1.5 million and $2 million of assets.
Okay. Wow. Fantastic. Okay. Well, let's see if we have any more questions here. Feel free to type in your questions here in your chat box. Again, I'm Anthony Bowling with the Anthony Bowling Group, and this is Chasing Gazillions. Ain't the same as making millions. A weekly coaching, career coaching call in real estate every Wednesday at 5 p.m. We're right here live discussing important topics that are important to you. If you are have an interest in becoming a real estate professional, you're involved in real estate, you own and control real estate, you are looking to make gazillions because some other program suggested that if you paid their $21.50, you could make gazillions in real estate. We're here to give it to you straight, to bring you, competent, knowledgeable, courageous professionals like Dennis BoBo, to give it to you straight, no chaser, as to what really matters here as you are building wealth for your family and protecting your assets, all your assets. So let's see. We have any more questions here? We still have some time here remaining. Dennis, someone asked related to this last one about buying real estate under a trust,
Sure.
or no, putting it under a trust. They're asking, I have a mortgage on my property now. Can I put it into a trust now?
That, Anthony, is an amazingly great question. And Anthony, as I said, I'm a humble student and a humble steward. So that's a question that I would have to take a look at and probably speak with an attorney in that particular situation.
Okay.
But
right.
here's what I'll tell you. One, whomever gave that question, feel free to contact me. I'll be glad to have a private consultation with you on that matter. And one of the things I try to do is bring subject matter experts like Anthony in real estate. Also, I work with a trust attorney who helps facilitate the setup of the charitable remainder trust and also the irrevocable trust. I work also with other CPAs and accountants also. We work as a team effort as it pertains to your strategy and solution. And here's the wonderful thing. My professors, you are my professors. So a question, when you bring me a question like that, you just gave me homework. So I'm going to go do some homework and I'm going to give you an answer next time we speak. If it's when you book an appointment or if Anthony brings me in to have a conversation about trust that are encumbered by mortgages. I will answer your question thoroughly at that time. But not only will I answer your question, I promise to have a strategy and solution for your problem.
Fantastic. Well, Dennis, we certainly appreciate that. And, we would welcome, yes, you gave us just the tip of the iceberg, and we want to bring you back. And as time permits, we welcome, and we certainly going to arrange to bring you back. I'm glad you mentioned about the collaborative nature of working with other competent professionals. Individuals oftentimes make note that I am an attorney. I'm also a certified commercial investment member in commercial real estate because I serve as the director of our commercial real estate team here at the Anthony Bowling Group. But I'm always quick to advise all my clients. I am an attorney, but I'm not your attorney. I'm your real estate professional. So although I am trained as an attorney, I'm not your attorney. You see, so I'm always quick, and that's a very important message to get across when you are evaluating professionals to be on your team as you are moving forward to develop strategies to address the myriad of real estate related matters in your life. You want to make sure that individuals are staying in their lane and that they are both competent and confident in their area of expertise, because you just don't want someone who is sort of kind of doing it on your matters. Hey, fantastic discussion. Needs to say I'm not partial.
I think that's my mother.
That might be your mom. Hey, BoBo, all right. Hey, man, I love it.
Sure.
I love it. It's like we got all these people here and they're all out there on live and all.
Sure.
But the dude's mom, his mom is still in here getting it, still learning, still.
Oh, man.
You gotta love that. I love that. Hey, Mom, thank you so much, dear, for coming and raising such a wonderful human being and such a good citizen.
I paid you to say that, Anthony, but thank you. I appreciate that.
Well, hey, man, the marketing dollars go far, man.
Awesome, brother. Absolutely.
So we're still open. If there are any other questions, we're happy to take them. We here on Wednesday during this career real estate coaching hour. We don't have to stay the whole hour, but we are here for you. If you have other related questions about real estate, about the subject we just talked about, capital gains and avoiding those capital gains taxes, you don't have to be a gazillionaire to face an awesome tax liability where, your mom's purchased a house in the 80s, needs financial support now, and she needs other assistance now.
That's right.
And she wants to go to Boca. So I heard she wants to go to Boca Raton. She wants to go to Boca. And so you're going to sell mom's property to turn it into cash. And now you're going to have the IRS take a hunk of those proceeds unless you avail yourself of strategies like the ones that were laid out here today by Dennis BoBo and his team on how you can legally, properly avoid these tax liabilities. Now, we didn't write the laws. Somebody else was writing the laws for their benefit, whoever they are. But now we know, and we have other persons, other scribes who also know and have studied these laws, understand how they work, and you now can be a beneficiary of that training here. So contact Dennis. Dennis, tell everybody, how do they get in touch with you again if they want to set up a confidential, private Zoom call, telephone call? If you're old school and you still got a rotary, you can still call Dennis. Tell them how they're going to find you. Give them all your numbers, Dennis.
Absolutely, Anthony. First and foremost, I guess if we're new school, go to global taxsolve.com and just click book now. You click that link, and you are going to get to be able to schedule an appointment with me at your convenience. And Anthony, if you can bring up that last slide, I'm gonna give you guys my office number.
Okay.
That number is 301-658-2310. And the reason I said the last slide, that has on it my contact information. So that's 301-658-2310. And that website is www.globaltaxsolve.com. So if you go there, you can remotely click and call, or you can feel free to give a call to 301-658-2310. Leave a message for me or my administrator. We'll get back to you within 24 hours. And I'm here to facilitate whatever your requests are. Also, not mentioned also, if you really need to contact me directly by email, forget about email. Email does exist. Contact Dennis BoBo. That's DENNISBOBO at pbfglobal.net. Again, that's Dennis BoBo at pbfglobal.net. And by phone, by clicking or call or email, I'll be glad to help navigate you through your tax trials and hopefully not tribulations. And Anthony, can I say amen to something you said, if that's okay?
Go right ahead, Dennis.
Anthony, as you were talking about strategy, and you were talking about navigating the laws, it really, in my heart, I was saying, I was having an amen moment at that given time. And what I mean by this is that something happens, and this is really what I believe. It's let's not be grandma trying to plan for what she has to do after it happened. Let's not be grandma be trying to plan to do what she's going to do on April 14th of the following year, and realize she's got a big transaction, a big tax bill coming. Because that kind of puts you into what they call a tax evasion position. But let's be strategic, as Anthony mentioned, and then we can be in a tax planning position. We can plan for the transaction, strategize for the transaction, receive and realize the outcome that we were looking for without having to have the negative impact potentially of a call or a knock on the door from not just the Internal Revenue Service, but a Treasury agent, and liability, seized assets, what have you. And that's making it extreme. And Anthony, you said something else that was really important, and I learned from my very first job in tax at Arthur Anderson, as a meager, lowly tax associate, crunching data, entering numbers. And I was lucky enough to work on the tax return of one of the heirs of the Getty estate. So we talk about trust. Here's a trust example. and we're working in that return as a lowly data entry guy. So young man like myself, only difference, we made probably about the same that time, about 30 years ago, probably maybe 15, 20,000 or less. He worked for a nonprofit. I can relate to that. But what was a little different is that he had $1 million a year in his early 20s from his trust, from the Getty estate. And so an amazing thing is they sent me the organizer and I was entering information in, and I was like, well, and I sent it back to the junior staff, and they sent it back to me for revisions, and I'm seeing the liability go down, and I send it back up and it goes to the senior staff, and they send it back to me revisions, and I'm seeing liability going down a little more, and I send it back up and it goes to the manager, and it sent it back to me for revisions, and I see it went down significantly more, and then I send it back up and it goes to the tax attorney, and I'm looking and say, wow, it's really gone down quite a bit. And by the time it comes back from the partner with signature, that would have been a 6-figure liability on that $1 million+ that that young 20 some odd year received, turned around to being a $1,500 refund. And at that time, and at that moment, I realized that if you understand the tax laws and you understand how to apply those tax laws, you have a direct impact on the bottom line. Furthermore, what happened was that young man's taxes didn't get done, just get started being done that year. That happened before that young man was even born. Probably, maybe when his dad was a young man, maybe even before his dad was even born, because maybe his grandpa or great grandpa went on and sat with old man Anderson and the attorneys, and they sat around and put together the trust. And they said, well, my grandkids receive this residual wealth from this trust. I want you to structure certain mechanisms in place so it will have the desired results. Now, in the future, we don't know who's going to be working for you 50 years from this day when we're sitting down and going through this trust. But what will happen is they will interpret the instructions that we have today, the plan that we lay out. And so when my grandson walks into your office 50 years from today, I might not even be here. They're going to interpret what we have laid out today. And that is going to result in a $1,500 refund on $1 million of income. So that is what planning, that is what professional advice, that's what interpreting the laws does for you. And guess what? If the IRS looks at it, Department of Justice, all they can do is shake their head and say, well done.
Well done. Well done. Well done. Dude, dude, you got me shaking here, man. You got me shaking in my boots, man. I love it. I mean, man, because when that kind of truth hits you, it pierces your heart. I mean, that's what we get here on Wednesdays from 5 to 6. Chasing gazillions ain't the same as making millions. But Dennis BoBo is telling you how you can transfer wealth. Start now. Start planting the seeds now for grandkids that you don't even know are coming, and putting a plan in place today. Not for you, but for grandkids. Not your kids, your grandkids, right? And putting a plan down that they follow that's going to result in them getting not a $600,000 tax liability, but a $1,500 refund and no tax liability. Thank you, Dennis. We are at the end, brother. We are at the end. Thank you so much. Thank you all for joining us here today on Chasing Gazillions. ain't the same as making millions. It's a career real estate coaching call. I'm your host, Anthony Bowling, with the Anthony Bowling Group, and it's my privilege to come to you here every Wednesday at 5 o'clock, talk about real estate related matters, how you can become a real estate professional, and bring you all kinds of other related information. I appreciate that you've come here and spent this time with us today. And before we leave, I always like to close by telling you right now, if nobody told you today that they love you, I love you, and there ain't nothing you can do about it. Hey, you all take care. We're going to see y'all next week, next Wednesday here, 5 o'clock. All the best. Take care. Thank you again, Dennis BoBo, and thank you all for being a part of this presentation. Take care. Bye-bye.